Welcome back to Leaders Live. Welcome back here in New York City. We have a good show today with Mark Loranger, co-founder of Braavo Capital. Very excited to have him on the show today. Definitely want to make sure that everybody who jumps on the show today checks in. Definitely say hello, put your LinkedIn page in the comments section, start networking with everybody. But with that being said, I want to pass it over to Michael Mara, the CEO of Entre, our partnering sponsor. Mike, how you doing today?
What's up, Charlie? I'm good, man. I'm good. How are you doing?
Good. Excited to be back,
For sure. Yeah, I'm looking forward to this. I'm really excited about what Mark's doing. So I'm looking forward to hearing his story and everything that he's doing with Braavo Capital. So I'm thrilled to listen to his story. If this is your first time coming on, I'm Michael. Like Charlie said, I'm the CEO of Entre. We're a social network for the future of work, entrepreneurs, freelancers, investors. We just rolled out our mobile and web app. We're doing a more public launch coming up in a couple weeks, but you can connect with thousands of other like-minded people doing cool stuff on our website, joinentre.com. You can download it on the app stores. We're doing a ton of cool events like this, interviews with top CEOs, investors, angels, all sorts of different panels, workshops. We have a couple pitch competitions that we're doing coming up. So if there's anything that we can do to help you guys, please let us know. I'll drop some links and stuff in the comments here. Wherever you're watching, whether it's YouTube, Twitter, Facebook, LinkedIn, just drop any questions that you have for Mark throughout the interview. I'll be keeping track of everything, and then we'll do a quick Q&A at the end to wrap things up. But looking forward to this, Charlie. Thanks for another great episode of Leaders Live.
All right, awesome. Thanks, Mike. And definitely check out the Entre app. Go to joinentre.com. That just rolled out recently. I think it's a really cool community. It's catching a lot of steam. A lot of people are signing up. I see people checking in right now, so definitely keep checking in. Put your LinkedIn message, your LinkedIn bio in there. I see Patty joined. We're going to do the questions, as Michael said, at 3:30. So start asking questions as we go on. And if you hear anything special, definitely make a comment of that so that we could clip it and then reshare it with the community. But with that being said, let's bring in Mark, our guest today. How you doing, Mark?
Doing well, Charlie. Thanks for having me today.
Absolutely. Very excited to have you on. There's a lot to talk about. But before we get into the business of Braavo, what you're doing, which is obviously very exciting, let's start back a little bit, give a little context what you were doing before. You got a pretty cool background story, so give us some context what led up to Braavo and how you doing in your early business.
Sure. Yeah. So I mean, that's a loaded question, right? The question is, how far do you go back? Certainly, my career has been pretty nonlinear. It all makes sense now in hindsight, but at any point in time, it would have been hard to figure out that trajectory. But I went to school for engineering. Went immediately to business school, and my first job out of grad school was doing technology licensing at MIT. So I was working in academia. Entrepreneurship, technology entrepreneurship wasn't really something that was top of mind for me. Both my parents were teachers. I went to school for engineering, but not in a place where, building a startup was something that was sort of a typical path. So, when I was at MIT, I saw a lot of true technology companies being formed. We would, put patent licensing agreements together, and these companies would raise venture capital and then go build a business. And interestingly, under the licensing agreements we created, there was, the financing terms usually had some fees and then royalties, a way to collect money from some future residual cash flows that the university would get for the benefit of licensing the technology. And the reason that this sort of detail is important is because it connects to even where we are now with Braavo Capital. So from MIT, I went over to BU, did something similar, but we had some investment funds. So sort of with an investing hat. And then I went over to what was called at the time Square One Bank, a venture bank, competed with SVB. That's now Pacific Western Bank, so they were acquired by PacWest. And at Square One, I ran an early stage practice. So I worked with a lot of early stage technology companies, both in an advisory capacity as well as providing them basic banking services. My goal when I took that job was to join one of my portfolio companies in an operating role, because I decided at the time that I really wanted to join a startup. I wanted to be an operator. I wanted to know what it was like to go from conception all the way to execution and scale. And I thought that would, as a professional challenge, sort of be the ultimate next step for me. So from square one, I went to a company called Updater. I was the third employee. There was a founder and one engineer. I joined as COO. Updater is based in New York City, still around. I was there for about 2.5 years, and that's when I started Braavo. I left Updater to start my own thing. So Braavo is the first company that I am officially the founder. That was kind of the final culmination of this path that I took to sort of immersion in entrepreneurship and financing and venture capital and everywhere in between. And so that's kind of what brings us to where we are today.
Yeah, absolutely. I mean, that's a nice little journey there. From venture capital, working with the financing aspect and operating side. What lessons learned did you take from, that I think Square One and Updater that you take with you today, especially, running your team and everything?
Sure. Yeah. Well, at Square One, I was exposed to sort of the world of debt. I didn't know much about debt for technology companies, and I also got to meet with a lot of really promising early stage entrepreneurs and early stage technology companies, and sort of built my own hypotheses around what it took to be a successful entrepreneur, what it took to sort of grow an early stage company to hit inflection points that would prove value, enterprise value that may mean that you can hire somebody great. It may mean you can raise money. So I kind of built my mental framework around early stage startup growth at Square One Bank. And then at Updater, I learned about all the things that I thought I knew that I wasn't very good at after all. It's the humbling thing about becoming an entrepreneur and working in an early stage company is even the smartest people, even the most talented and capable, there's a lot of things you're just not good at. And you have to do them when you're running an early stage company. And so, what I realized over and over again at Updater was how important it was to identify weaknesses in your own skill set. Do the work that needs to be done, but get the organization to a point where you can hire people that are much smarter than you, much more capable, much more talented in a particular domain. Because as sort of an early stage operator, you're doing a lot of different things, but not nearly as well as somebody who's an expert in the field should be able to do them. And so that was kind of the probably the most important lessons that were learned at Updater. Yeah.
Well, it's interesting. I mean, you're working with a lot of startups, you're advising them, and you're hearing all these stories, and then you jump over to the COO role at Updater, and you're getting your hands dirty. You're really seeing it. You're living that entrepreneur life, which leads us here to Braavo Capital, which is exciting because tried and true. You've been there, you've seen it, you've got all the lessons. But again, the financing solutions for mobile apps and gaming, funding the mobile growth. Talk about what you're doing at Braavo, and the exciting stuff that's going on.
Yeah, so at different stages of my career, I was exposed to sort of the different ways that you can build technology companies. You can raise venture capital, you can bootstrap, you can raise seed financing, you can raise debt, and over that course of time, I started to sort of think about what I believe to be the right way to build a business, and where I thought the world was going. And fortunately for me, when I was still at Updater, I met my current co-founder who had already started packaging this idea of alternative ways to finance technology companies. And basically the vision here is, it historically, the venture capital industry emerged to provide high risk capital to companies that would take many years and many millions of dollars to get a product to the market. You would do R&D, you would commercialize this microchips and pharmaceuticals, for example. You would probably get some patents to create some sort of a long-term competitive advantage. And eventually you would have a product in the market and you start making money. But the venture capital was like this way to get there, to invest millions and millions in commercialization well before revenue. And where we are today is you really just don't need to invest too much money to get a product to a point where you can generate traction and revenue. And particularly in the app world, where there are these standardized frameworks upon which products are built. Those frameworks are the app stores, and then you have these infinitely powerful distribution channels, again, the app stores, to get product in the hands of end users. It's an entirely different model for building a business, and yet most of the companies that were building these businesses thought the only way you could raise money was venture capital. And we believe that the venture capital is a good solution for a very, very, very tiny portion or subset of those companies. The vast majority of businesses shouldn't raise venture capital, should build more sustainable business models. They're not necessarily going to create billion-dollar unicorns, but you can build tens of thousands of very successful companies doing things a little differently, incrementally iterating, incrementally funding, profitable growth channels. And ultimately, I think that creates a better set of possible outcomes for entrepreneurs to be able to fund your business in more creative ways. And that was kind of the foundational vision for Braavo to find ways to provide capital to mobile apps and mobile game businesses that is non-dilutive, that doesn't take control, that doesn't take equity, but also is scalable in such a way that you can build a big company if that's the path that you're taking. We're not prohibitive from raising other forms of capital. We're sort of complementary, but we're a solution for a lot wider breadth of companies, a lot wider breadth of businesses. And ultimately, if you're not necessarily selling a big chunk of your company to equity investors, you control decision making all the way through the process, and that creates, again, as I've said, sort of a more, I would say, sustainable and healthy way to build a business.
Extremely important to have that flexibility with building these apps. I mean, you stated that you help with the starting of building an app to building and scaling. There's different stages, I think, when people are building these apps. What do you see, some of the trends being, or how do you guys advise these apps or these gaming companies through those stages? And like, how do you, communicate that and visualize that?
Well, yeah. So, I mean, it sounds like it's a very specific, domain of business model, right? Mobile apps and games, they're built in the app stores as in-app purchases, and that's that's the business. But there's many different types of business models that fit within that architecture, right? You can have weekly subscription apps. You can have casual games that people play in the subways that are monetized purely through ads. So there's hundreds of different business models within that world, and so it's hard to give sort of one size fits all advice. One thing that's important to keep in mind for our business is we provide funding that is expected to be repaid. So our customers need to be generating revenue. You need to have an app in the market, and you need to be generating revenue. Those are sort of fundamental baseline qualification criteria. If you haven't started generating any revenue, well, then it's impossible to know if it will get repaid. And if we're not taking a big chunk of equity, which we're not, then we need to get repaid in a relatively understandable period of time. So for companies that fit our criteria, again, they have mobile apps, mobile games, they're generating a little bit of revenue. They could be very early stage. It could be as little as $10,000 a month in revenue. And the advice to those businesses is continue building the business the way you believe you need to build it to prove to yourself that you can scale, that you can grow revenue traction. Typically, that's in the form of two important things. Obviously, like how to monetize a user, especially three things, right? How do you acquire users? How do you monetize them? And how do you retain them for a long period of time? The retention piece is sort of the third stage, right? Like you have to get them and you have to actually get them monetized, then you retain them, but that might be the most valuable piece. Generally, the biggest limitation to scaling and building real enterprise value in any app, mobile games or mobile apps that are subscription apps, meditation, for example, you want to be able to retain users because those users should continue to pay over time. And that's how you build a base of revenue that helps you scale. If you're just churning through users, you might be able to acquire them. You might be able to get them to pay you once, but if they're gone, it's a hamster wheel. And so typically, like whether it's a game or any sort of non-gaming subscription app, you have to figure out how to acquire users, how to monetize them, and retain them. And then if you do that efficiently and you can do that profitably, then you can scale. And you can scale in such a way that you don't have to continue raising more money from investors and selling big chunks of your company because you're generating cash flows that can be leveraged by financing platforms like Braavo, and that helps build a successful, profitable business. Again, not necessarily exclusive of raising equity, but if you raise a big chunk of equity, you should be pouring that into building your enterprise, technology, team, partnerships, defensibility, content. That's sort of where the equity dollar should be going.
Yeah, I mean, you mentioned the retention obviously is a huge thing, right? And then the scalability. You obviously know about growth scalability when you were at Square One Bank. You led a team that set records with customer growth. So what are some of the tips that you have used in the past and that you possibly give as advice to some of your customers or whoever it is, your peers, on growth and scalability?
Sure. Well, yeah. I mean, there's two different hats that I have to wear when I sort of answer this. So one side is B2B growth, right? If you're acquiring other businesses as your customers, which was like the thing I did at Square One and what we do at Braavo, we're acquiring businesses, B2B sales, versus B2C, which is apps that are acquiring end users. That's a different game. So maybe we can focus on the B2B side because that's kind of really more of my expertise. You have to build predictable systems to acquire and close new business. And predictable systems can be a sales team that follow very, very clearly understood processes where you can generate metrics that are predictable. Once you have predictable metrics and you know what the economics are of acquisition, you can hire more. You can program sort of steps along the way. You can specialize team members, and then you can actually scale a sales organization. That sounds simple. One of the things that worked for me in building, my sort of sales process at Square One Bank, and something that we're always trying to optimize at Braavo is, leveraging your customers as amplifiers for your business. When you're doing when you're in B2B, and you are particularly an early stage company, right? You don't have a ton of resources to pour into a sales machine, right? You're not going to hire 100 people, and you're not going to build incredible sort of marketing cadences that have 100 different audience segments and drip campaigns and PR and paid acquisition on Google. You just don't have all those resources, right? Yeah. So if you can acquire some set of customers and really delight them, really make them incredibly happy with the experience that they have. And we've done that with Braavo, and they value the experience, they value the partnership. Those really happy customers can be massive brand amplifiers for you. And that can augment or sort of, create a sort of a sales force, an external sales force of sorts that help you scale without necessarily pouring the resources in internally. It's easier said than done, obviously, but with Braavo, we really focused for our first couple of years on not investing really any resources in sales and marketing. We put all of our resource into technology, building products and features that our customers needed, listening to our customers, focusing on that small core group of high value, highly engaged customers, and building the tools that they needed to be successful. And that creates a really enduring relationship. And then those companies can really be amplifiers for you in the market to help juice your very lean marketing and sales efforts. So, prior to building that big sales machine, which you need to build eventually in B2B, you have to be clever and creative ways to amplify the message. Maybe you're really good at PR. I'm not. We're much more, I would say, pragmatic people, and we're more on the sort of technology side than the marketing side as a company. And so we build tools and products and features and rich relationships with a smaller number of customers early on to help us do the things maybe that we weren't good at. And that's even going back to my lessons learned at my last company, which is you have to identify the things you're not great at and figure out ways to either fill that with talent or sort of work through that. And one of the ways for us in terms of improving our reach was using our customers as brand amplifiers because they were extremely happy and successful as a result of working for us. One of the coolest things about the experience with Braavo now that we're 4 years into it is one of our earliest customers who was a business that was able to scale pretty dramatically just working exclusively with us. They became so profitable that they said, hey guys, like, we love what you're doing. We'd love to put money back into the system. And in fact, they've become a capital partner for us on the debt side because they built that successful business for themselves. They followed their path, and now they're sort of an ecosystem capital partner, putting money back into the system. And so it's a very, very fulfilling thing to see that. And realistically, that company, had they raised a lot of venture capital, for example, they would not have been able to do that because they would have had to keep growing. And what they realized was they hit a kind of a ceiling of growth that they were very comfortable with. And they just were running a very profitable, comfortably sized business. And they said, well, we're generating a lot of profit. We're not going to keep pouring money into this business to try to build a unicorn because we believe we've hit a ceiling of scale. And instead, let's pour money back into things that we think are really interesting, that we want to be a part of. Maybe it's to get some small return, like a high yield savings account, or maybe it's to start a new business work on a new project, maybe enjoy your quality time because you built a successful company and you're not trying to kill yourself to get to that next stage. So, that's a sort of a long-winded answer to your original question. But
yeah, no, it's good. You're dropping gems all over the place, and it's all solid. And there's a lot that you just put out there that I'm trying to pick up and throw out back to you. But the metrics and understanding the metrics, I know there's a data play with Braavo too. And I'm sure that helps with the metrics. Can you discuss a little bit about that and understanding the data? Because I'm sure that helps, understand where you're going to go.
Sure. Yeah. So if we go back to what I was saying earlier about like how it takes less resources to get a product into the market, and therefore, you should be able to find other sources of capital. A related concept is the fact that there's a tremendous amount of real-time data that is characterizing the health and performance of companies that you can access and really measure sort of the underlying mechanics of businesses in real time if you build the technology to do it. Again, historically, building a technology company may take 2 or 3 years to get to market. There's no real data. It's like, okay, they're hitting these milestones on the commercialization, but nobody's buying it yet. They're not even selling it yet, right? Now we can actually see in a very short period of time how many installs a company is generating, how they're paying for installs, how they are sort of converting an install to a paid user, how they're engaging that user in the long term. And ultimately, what's most interesting for us in our sort of underwriting, the way we sort of measure risk and then provide financing from that, is sort of, it builds on a core truth about technology businesses, which is, whether it is a B2B SaaS platform, or whether it is digital content on YouTube, or whether it is a mobile app, a running app, for example, with technology products, engagement is sort of this precursor to revenue. In other words, like revenue is actually a consequence of building an engaging product or an engaging service or engaging content, right? If you can engage with end users with your product, that will create downstream revenue. So if you can measure engagement at a fundamental level, you really understand the value that the product, the value of the content, the value of the service is creating in the hands of end users, and the likelihood of those end users to re-engage, pay more, renew their subscriptions, buy more tokens on their in-app game. Or again, it's with content creators, the same thing. Subscribe to your channel, and that subscribers correlates to people that are watching your content, and that creates revenue in the form of media. So it's not just mobile apps and games. It's really any of these technology-powered platforms, content that if you can measure mechanics of a business at a really underlying level, you can understand the health of that business. You can understand the quality of the product in the hands of end users, and you should be able to provide some unique type of financing depending on the business model. And for us, again, the business model is contained within the app world, apps and games. But some of these underlying concepts, I believe, are true in general in the technology world right now. And if you can crack that data layer, and you can break it apart and you can understand it, you can create ways to provide capital to these businesses that historically would be considered high risk, but it's not as high risk anymore because you're actually understanding the data that powers the health of that company.
Yeah, and the high engagement leads obviously back to that brand ambassadorship that you were talking about, and the growth goes along with that. That's this is fun conversation. I like this. So talk about we talk about collaborations, partnership opportunities. I mean, what type of collaborations and partnerships do you see that work? Maybe give us an example of something in the past, and maybe some stuff that you're looking for in the future. So it's kind of a little two-pronged at what's worked in the past and what are you looking for in the future?
Well, yeah, I mean, speaking generally, again, I'm talking about in the world of B2B partnerships. Partnerships in B2B are usually driven by a mutual desire for some sort of shared outcome that has benefit on both sides, right? And for us, typically that means finding companies within our ecosystem who have a similar mission and mandate, which is to help app and game businesses grow, and to figure out ways that our product or our service is complementary to their product or their service with that shared end goal of growth, right? Of course, that shared end goal of growth is somewhat, I would say, it's not totally altruistic, right? We want these companies to grow because we want to be able to provide them financing. Our partner wants them to grow because they want to be able to sell them the next tier of their SaaS service, for example, or they want to be able to, provide a more marketing expertise for acquiring customers, right? Maybe they're an agency. Ultimately, it needs to have this mutual benefit, this shared benefit, this alignment on mission or vision. And then, I think in terms of collaboration and partnerships, it's important to both have executive level buy-in, but also to have the boots on the ground incentivized and bought into success as well. I think there's partnerships between two startups are always going to fail because it's just two startups and they don't know what they're doing. What you really need is you need to have a really sort of well thought out system for success, for measurement for success, but also for ensuring success. And usually that includes buy-in from the people that will influence that. Often in B2B partnerships, it's at like the account manager level, right? Like the executives think they know what the customers want. The product people talk to the customers and the customers tell them what they want, but the account managers and the salespeople are really on the front lines. And if they're not sort of aligned with what the customers want and need, then you have trouble sort of finding success. But for us, again, it's working with companies that have really strong alignment in the mission, which is like, empowering these companies to be successful on their own terms. And usually that means growing, but also alignment in what we believe to be the success metrics are. Like what are the success metrics? How do you measure that? Are both sides aligned with that? And who are the people that are going to make sure that that's successful?
Right. And that gives you the ability to filter out the bad ones and the good ones.
Yeah.
This is good stuff. Now I just want to mention that we're going to be taking questions in probably,
Sure.
I don't know, 5-10 minutes or so like that. So I see Patty's put a question in there. I see some check-ins from Miami. So definitely start putting in some questions because Mike will take that in about 5 minutes. But when you're talking about the partnerships and opportunities and collaborations and all that, it kind of leads into networking. Entre is a networking group, entrepreneurs putting together startup founders and everything like that. So when you look at networking, and whether it be new partnerships, new opportunities, new business or something like that, how do you network? What's the best practices? And, how do you stay in touch effectively?
I should be listening to your advice. I think that my guess is you're probably a better networker than I am. Networking is networking is hard for certain people. I think a lot of people in claim to be introverts. I claim to be an introvert. I am one, but I think that networking can be hard. I read a book. I had a mentor who gave me the book Never Eat Alone when I was 27, 28 years old, and I was like, oh my God, this is amazing. I need to be like this person. But I couldn't be like that. I need time to recharge and not network. So you have to, if it's not a natural thing, you have to train yourself. And the ways to train yourself in networking are, first of all, you always have to be authentic, right? One of my favorite parody Twitter handles is the let me know how I can be helpful. The VC parody. Every VC in a meeting, they'll at the end of it they'll say, let me know how I can be helpful. Often it's associates, younger VCs who really want to be helpful, but they really can't. But they say that anyway. I think that recognizing in any sort of communication networking effort, if you can be helpful, but then being authentic and actually putting in the effort to be helpful in any way that's possible, paying it forward. I think that's really important. Not just networking for your own benefit, but networking truly to actually help the other people be successful as well. I think if you're in it just to meet some sort of personal objective, then it's really transparent and people are less inclined to be helpful for you. So at least that's broadly speaking what I think about networking. In terms of if you're like starting a company and you're trying to meet people in the industry or meet people in the local ecosystem, networking is very important to make connections, to find people who be influential, who can be helpful, who are willing to share their time. In entrepreneurship, one of the things that you're always constantly reminded of is time is your most valuable and scarce resource. And so when people are asking you for your time, you want to know that like they're worth it, right? And so you have to be prepared to demonstrate why like asking someone for their help or their time is worth it for them. All of us like to be helpful if we can, but it's a cost benefit analysis sometimes. And like, I just don't have the time right now. My company needs me. And so, in terms of strategy around networking, as a young entrepreneur, one of the things that always stuck with me was knowing who was going to some event and then having a plan for yourself and setting goals. Like if you do your research and your plan and you're like, these are the 3 people I have to meet at this event, and here's what I'm going to say to them, and this is why they care. And then you don't leave until you see those people and you talk to them. And even if it's totally uncomfortable, and even if you suck at it the first time, practicing will make you better at it. But if you don't have a plan, you're going to fail, right? Like, and this goes back to my engineering sort of nature, is like, if you haven't planned for it, it's not going to be successful. So even if you're putting yourself in an uncomfortable situation as it relates to networking, if you have a really clear plan in mind, and you've prepared yourself, then even if you're really socially awkward, for example, you will get there. And I'm inspired by my co-founder who his last company he started, he moved to the US and he was doing all the sales. He started a company that was a custom software development company with all the engineers in Belarus, and he's native to Belarus, so English is not his first language. But he started to do sales and build his network in New York, and he just did it through just grinding. English was not his first language. He didn't know anyone in the market. He just went to events. He set a plan for himself, and he executed at every step of the way. And so, for someone who, if English is your native language, you've already got to step up on a lot of people that are going to these events. Remember, a lot of people that are going to these events, English is probably not their first language, and they're probably not from New York, and they're probably not well connected, and they're there doing it. And so, if you have any advantages, you should do it. But even if you don't, it's just about practice and preparation.
Yeah, I like you're saying, pick out those 3 people that are going to be at a network event that you know of. That's really the quality aspect over the quantity, right? Trying to figure out the right people that you want to talk to and try to. Lights came off here. It's all right. Yep. We'll stay lights off. The other thing, typical VC, is the Twitter handle you were talking about. Great Twitter handle. It's very funny how it can be helpful. So I wanted to point out, let me know how it could be helpful. I think the way to kind of do that is to be a little bit more proactive,
exactly,
and figure out how you can be helpful. So right now, as we're having this discussion, I know a founder his name's Matt Jarvis of Cash Live is releasing a new mobile gaming app, and I'm definitely going to make an introduction to you with him afterwards. But also, saying, do you think this person would be a good person to meet? Would this be helpful for you to meet him? And if it's yes, then I'll make the connection. If not, what is that, a waste of 5 minutes or something like that? It's not a big deal. Questions, Q&A questions. We're going to bring a Mike to ask some questions that I see coming in here. Mike, how you doing?
I'm good. I'm enjoying this. Mark's dropping some huge value bombs, and I'm loving his advice. And it's just a really cool, what you guys are, not only everything that you've talked about, but just what you guys are doing is really cool. It's just great to hear it coming from, just straight to the source too, and what you guys are doing and how you built it. I think, yeah, for sure. I think Patty's been asking some interesting questions here. I think the biggest one is, I'm going to pull it up on the screen here. So there's this whole, you guys are focused on companies once they have revenue already, right? Mm-hmm. For maybe companies at this seed stage, it's a very strange spot, because a lot of companies maybe just started making revenue, or they just got the product out. I'm sure you come across a lot of people that are in this pre-seed, seed, maybe even Series A, where they might not even be a great match for you yet. What are you telling, or how do you approach companies like that? Do you share any advice for them on hey, once you hit these numbers, or you should think about growing your mobile app, or do marketing this way, or to increase and scale, so that once you start generating revenue, we can keep funding you and pump more money in so you can keep scaling? Yeah. Do you have any advice for maybe companies that are more earlier stage, and then maybe not a great fit for you right now, but what do you advise them to do so that they are going forward?
Well, I think without getting on a soapbox and philosophizing too much on this, funding strategy and growth strategy should be defined by your long-term goals. What do you want to build? What are your aspirations for your business? What do you believe is achievable? What do you want to build? And then you work backward. So the question about seed versus Series A versus pre-seed and monetization, they're all part of the same sort of long-term vision. What do you want to build? If you're trying to build a unicorn and you've raised a seed round, and you really your goal with building that unicorn is massive growth in a short period of time, then maybe monetization isn't the most important thing. And so maybe you don't necessarily want to focus on monetization yet. Maybe you want to focus on gameplay to get people really hooked on the product. And maybe that is very little monetization. And same thing with apps that are sort of the intent is to have virality and scale, a social network, for example. If you start monetizing, then you're not going to get that virality and scale. So I think that you have to know what your long-term business vision and plan are, and then depending on where you are at a stage, you should think about when monetization is important and at what scale. For us, even as little as 10K a month counts, right? However, if you're trying to build a company that has 1 million users in a month and a half, and you're making 10K a month in revenue, well, we're not going to be able to give you enough funding to get to your 1 million users. You're going to have to find another way to do it. So in order to create drastic, rapid scale, if that's really your goal, your incremental revenue is not going to matter. If you're trying to demonstrate some traction as a business, and you're an early stage company, you're a seed stage company, and you want to demonstrate traction, well, revenue and retention are two ways to do it. And so you should focus on monetization. You should focus on sort of some fundamental core performance metrics that show to potential investors that you have a business that has some legs, that you have users that enjoy your product, that engage with your product, that are willing to pay you for that experience, and then figure out what that long-term story is to get to scale. It may include taking our funding. Likely you should, because, we'll, at the very least, working with a company like Braavo means that you don't have to raise as much equity. But that's sort of that intermediate story. And then, the third answer is, if you just want to build a profitable business, you should raise as little equity as possible. You should focus on monetization as early as possible, and then incrementally improve that over time. And then again, the idea of seed, pre-seed, Series A, it doesn't matter as much as what is your big vision, what is your grand plan, how are you going to get there, and what funding tools, venture capital, debt, non-dilutive financing, bank loans, whatever it is, what financial tools can you put in place to meet those goals? And in most cases, if you are building an app or game business, Braavo is a core part of that strategy, but it's not necessarily the only solution. The solution lies in what you're trying to achieve. Does that make sense?
Yeah, definitely. No, I think that was a phenomenal answer to that. And yeah, I think it's great because there's, you guys, what you're doing is providing that alternative and really helping people grow without giving up equity. The ones that are already making money, you have to grow and you need financing, but you're going to end up giving 20% of your company away to traditional VCs. So it can be tricky sometimes. And I think your advice from the get-go on understanding what you really want to build and being, aligned with that is so critical. So I think that was fantastic. We have a question here about how do VCs make money. Now, I would also kind of like to, you went into it a little bit, but I'm assuming they're talking a little bit about traditional venture capitalists. Obviously they make money from fees, and then they make money off of profits. Do you want to quickly, I know you explained it a little bit earlier, but you can reiterate a little bit the big thing. I mean, you guys are obviously making money based on interest from the financing that you're providing. Is that correct? And then
that's it. Yep. So yeah, the VC model, they a group of people, partners, associates, they have a fund, and it's a committed amount of capital that they deploy over some period of time. They have 2 and 20. They have a carry, so they get paid by a percentage of the fund. They split that among the partnership and team, pay their bills, all that stuff, and then they get a percentage of the yield or the returns that fund generates as well. So for a business like ours, we make money by charging fees on the money we deploy. So it's not interest, because our financing is fixed fee. We provide our customers with capital. We expect that capital to get repaid over some period of time, and there's a fixed fee on the money we deploy. It's not a traditional loan. There isn't structure like a loan would have, which usually includes personal guarantees and a fixed amortization schedule of payments. For most of our funding, we are relying on the likelihood of our customers to generate revenue in the future, and so it's a fixed fee model, cents on the dollar. So we charge cents on the dollar for the funding that we provide, and that gets repaid back over some period of time, depending on the type of financing, the expected duration, the company's scale and stage, and a bunch of other sort of data-driven mechanics. So it's all cents on the dollar funding, basically.
Gotcha. Yeah, and I think it's really cool what you guys are doing versus traditional. So and I think it's important for founders to understand how VCs do make money, and what they're looking for as well, because it's important when you're having conversations with them that you understand their point of view too. But I think you guys are much more aligned with founders than maybe some traditional VCs are as well. So it's pretty interesting for sure.
Yeah. I mean, I think we have a more aligned model. VCs are looking for the rocket ships, and so they're going to invest a lot of money in some finite number of companies. Some of those companies will fail because if they don't sort of have the trajectory that the VCs need to generate venture returns, they'll push them to either go out of business or die. Build that scale. For us, it's a choose your own adventure. We want all of our customers to grow sustainably healthy. Some of them will grow faster than others. But as long as our customers are growing and generating revenue, and they need funding, then we can be supportive of them.
100%. Well, I think that wraps up the Q&A. I'll pass it over to Charlie here to wrap up and have you share where people can follow you and find out more. And I know Charlie has probably one final question too, but thanks for being part of this. This was awesome.
Thanks, Mike.
For sure.
Awesome. Appreciate it. Mark, we usually just wrap up kind of with words to live by, personal mantra or ethos. I mean, just to kind of give a little inspiration for the day.
Yeah. Let's see. Well, one of the things that I really believe in is being authentic. And that means, saying what you mean, doing what you say, and that can be ascribed to just like interpersonal relationships, or even when you think about marketing. Authenticity is really critical, particularly when you're trying to build a sort of value that is contained within a brand or an experience or an emotional reaction. So it's authenticity is like not necessarily selling the dream, selling the reality, or maybe like the reality with some sugar on top, but then delivering on that. And I think that's how you build rich, enduring customer relationships. And that's really what we pride ourselves on at Braavo is retaining customers for years and years. Among the first 4 companies we acquired, 2 of them are still customers 4+ years later. There's a reason for that. And that's because we've delivered on our commitment to them, and been authentic in that process. So that's one thing. And then sort of the inspirational stuff, everyone's heard this now, but 10 years ago, I at least I hadn't heard it. Is that like the man in the arena quote from Teddy Roosevelt? You'd rather be in the arena and covered in mud and getting your ass kicked than being the critic on the outside saying, why aren't you doing it this way? And so that's sort of motivated my career decisions, at least. And you got to take some risks, and you got to beat up, and you need to fail in order to sort of really achieve I would say sort of like inflection points of growth versus just sort of steady incremental things. And that's in a personal level as well as professional.
That's awesome. Where can everyone find you? Where should they check out? I guess Braavo.com.
Yeah. So our website is getbraavo, BRAAVO.com, Braavo Capital Inc. You can find us on LinkedIn. You can find me, Mark Loranger, on Twitter, and any of the typical social channels where you might be searching.
Cool. This was awesome. Very helpful. I really appreciate it, and definitely going to share this out to my network. So,
Charlie, I appreciate it.
Yes, absolutely. All right.
Thanks for having me, guys.
You got it.
All right.